Hello, good morning. Hope we are good. Um, Nehemiah here once again. Today we'll be talking about capital structures, and then we will talk about some are behind it. And yeah, I want to also move fast today because we are closer. We are getting closer to exams. So let's talk about it. So let's start with short-term financing. So short-term financing is like basically financing a firm with like short-term debt, right? Which can be overdraft and the likes, bank overdraft, and then some quick kind of credits and the likes. So the advantages we have over short-term financing can be we can get it faster, right? And then it is less restrictive because since you get it faster, you are going to pay it faster. So it is less restrictive. And then it has like low interest. It has low interest as compared to long-term financing. And some of the disadvantages can be compared to long-term debt. Rates on short-term debt are variable and can be problematic if rates rises. So because it is short-term, it changes. You see, when you apply for a long-term debt which have 10% in the year, right? For like which has like 10%, for example, the 10% is static till you are done paying. But for short-term debt, each time you go and there is interest rate increase or decrease, it will also change, right? And then it has less time to prepare for repayment in hard time. So if your firm is not really performing well, it's very difficult for the firm to pay for the short term debt because it is being paid in a short duration, right? This might force you to maybe borrow money from somewhere else and then pay for that debt and then retake that debt again to go and settle the other one. So that's one of it. So financing decision, short-term debt is debt that is up to 1 year, and the medium-term financing or medium-term debt is a debt that is from 1 to 5 years, between 1 to 5 years. The long-term financing is over 5 years, which can be either debt or it can be equity. Sources of financing. So we have private arrangement, which can be banks, private placement, and etc. We can also we can also get financing from the money market and the capital market. And also, we've spoken about money market and capital market already in the previous sessions. I don't need to explain it. And then also supplier's credit, where the supplier can also give it to you on credit. And then concessionary loans from official and multilateral sources. And also, let's talk about the third party, which is financing cost, and then financial intermediations. Right. So sources of financing in Ghana: banking finance, mostly short-term form, which can be overdraft, line of credit, auto loan, mortgage loan, loan for other purposes, which can be Barclays loan, Standard Chartered mortgage loan, promissory notes, and foreign loans. So promissory notes is almost similar to commercial paper, so it is also same here. And other can be accrual, work done on credit, trade credit, usually not free. And then commercial paper is also similar to promissory note. And then bankers acceptance, sorry, it's more or less like the banker or the bank will talk to the person that he will it is more or less like the bank is serving as a collateral when you are transacting with someone. So your bank is serving like a collateral, telling the person that he will pay the money if in case you don't pay. That's the banker's acceptance. So equity or dividend. So dividend, what are they? So dividends are distribution of companies after tax earnings, right? That are distributed over the available shares. So distribution of a company's after tax earnings to shareholders in proportion of the number of shares. So forms of dividend, we have regular cash dividend, extra special dividend, stock dividend. We also have share repurchase dividend, and then we have dividend reinvestment plan, which is more or less like DRIPS. These programs allow investors to reinvest their cash dividend into additional shares or fractional shares. So goodies that are given out at annual general meeting. So now let's talk about how dividends are paid. These stuffs are almost self-explanatory, so I don't really want to explain them when we get to the technical part. So how are dividends paid? They are paid at the announcement, which is when it will be recorded, and then the ex-dividend date, the register closure of date, and then dividend payment date. That is the trading with or without the dividend. So dividend payment procedure, let's talk about it here. So initially there's an announcement date, which is when dividend is being declared, right? And then next there will be an ex-dividend date. Shares begin trading ex-dividend, so which is more or less like when the shares begin trading, right? And then the record date is 2 days after the ex-dividend date. So dividend will be paid to shareholders who own the stocks on this date. So we can see from here that the ex-dividend date is May 17th, and record date is now May 9th. So record date is 2 days after the ex-dividend date, and then payment date. This is dividend. This is when dividends are distributed to shareholders of record on the record date. So people who were having dividend on the record date, right? Who are having dividend on this record date are those who are going to be paid. Dividends and capital structure. So dividend policy. Let's talk about dividend policy. Position of the firm in respect to the size of cash dividend. So implication of capital structure. Dividend have bearing on capital structure. If the firm retains most of the earnings so as to be in a position to undertake future expansions, then low dividends being paid now are consequence of the firm investment decision. And if the firm retains most of the earnings so as to be in the position to undertake its investment, and as a result it pays generous dividend, then this time the generous dividend are as a consequence of the firm's financial decision. Yet another firm may pay low dividend because of poor earnings. The lesson here is that large or low dividend in themselves are neither good nor bad. The issue is rather about why dividends are low and why dividends are high. So this also is self-explanatory here. Dividend controversy. So does the value of a firm depend on whether it pays dividend or on how much dividend it pays? Consider a perfect world, right? More or less like a perfect competition where there is no taxes, no transaction cost. Firm earns, let's say, 400 million cedis this year and has a positive NPV project it wants to invest in, which it must invest in the next year, which will cost 500 million, right? If it pays out all of the 400 million next year, it will have to raise 500 million to invest in the project, right? Which means maybe the firm is going to borrow 500 million to come and then invest in this, right? On the other hand, if it pays out 200 million out of the 400 million, it will need 300 million to undertake the project, right? So under this scenario, the value of the firm does not depend on whether the firm pays out high or low dividends, right? Its value depends on the project it invests in. Thus, in the perfect world, dividend policy is irrelevant. That is according to Miller and Modigliani, 1961. So Miller, in this session, for example, we'll be talking more about these guys. They, like, you can, when you get time to, you can read about them. Their theories make it. It was making sense here. It made sense. It even won an award. So continuation. Consider an imperfect world where there is taxes and transaction costs, right? Thus, for each 100 million in the face value is raised, the company actually receives less than 100 million, but bears the cost of raising 100 million. This is the impact of transaction cost. So let's say if the firm wants to raise money, right? Want to raise, let's say, want to issue shares, right? Or want to issue debt to, let's say, fund its project, for example. If the firm wants 100 million, right? The firm won't actually issue shares of 100 million. Yeah, the firm will issue shares of 100 million, but it doesn't mean that the firm is actually getting 100 million. This is because there will be some transaction cost in issuing of the shares, and then you have to acquire an underwriter to do everything for you. So with that one, the cost and everything of the underwriter will come and then be added to the 100 million. So meaning that you will have to, when you are issuing 100 million, this thing, you receive 100 million, right? But you have to pay those who helped you in raising that particular amount of money. It's more or less like someone, for example, it's typical here in Ghana that when someone is graduating, like graduating from, let's say, a hairdressing or anything like that, he or she will hire an MC to come and then talk to people to fatensi the brand never pay balu for way brand away for way brand away, right? Maybe you can raise, like, let's say 20 million there, right? But you have to pay the MC. So the cost that is involved in raising that 20 million is like paying the MC, hiring a place for the program, paying for the chairs, the drinks, and everything, right? So those are more or less like the transaction cost, right? So in such a world, firms may be reluctant to pay high dividend if they must then turn around and raise funds in the market and bear transaction cost, right? So that, consider a next situation in which humans law restrict pension funds or banks to hold shares of companies that have a history of paying generous dividend. A profitable firm that does not pay dividend will not be attractive to a pension fund, right? Because the pension people, what they want is that they want their money to be yielding interest, right? So that it can cater for the rest of their lives that they are living. So if a firm is not really paying high dividend to really take care of them, then the firm's shares won't be attractive for other pensioners. So consider yet again the situation in which human law tax dividend at a higher rate than the capital gains. In such a situation, investors will prefer companies that pay little dividend, and as a result, their share price go up more, resulting in capital gains to investors. In the one case, one clientele sees extra value in firms that pay generous dividend. In another case, another clientele sees extra value in firms that pay minimum dividend. Other situations in which may matter include investors looking to dividend payment as regular source of income, less transaction costs compared to selling shares, and then market in which information is not readily available. Dividend payments are viewed as concrete, right? So if information about a particular firm or about the market is not really available, right? If a firm is paying high, they think that the firm is doing well, and then if a firm is not really paying high dividend, they assume that the firm is not doing well, right? So information as against mere earnings announcement. Thus, imperfections in the real world plus possibility of attainment of perfection have given rise to the dividend controversy. So these are the dividend controversy. One is saying that dividends are irrelevant to the value of the firm. Another one is also saying that generous dividend add value to the firm. This is because when when high dividend is being paid, people will assume that the firm is doing well, so they will come and then invest in the firm. And also, another one is also saying that generous dividend reduce the value of the firm. This is because when people are paying more, when the firm is paying more of dividend, then it means that the firm is giving part of its retained earnings to the people. Therefore, it's not able to invest in other projects that will make the firm value increase. That's what it means. So capital structure and the value of firm and the firm value. Understand the effect of financial leverage on cash flow, cost of equity, and then weighted average cost of capital. So we will also be talking about Modigliani and Miller propositions 1 and 2. Understand impact of taxes. Consider impact of bankruptcy cost, optimal capital structure, observed capital structure, long-term financing long-term financing, considering financial distress and bankruptcy. So, does capital structure matter? Put differently, does changing capital structure affect the value of a firm? Which is when we are acquiring, when we are using more debt to finance a firm, does it really matter? Does it really have an effect on the firm? Or when we are using more equity, does it have more effect on the firm? So this is what we are coming to talk about here. Note that the objective of management, including board, is to maximize the value of the firm, right? Is to maximize the value of the firm, which is directly proportional to increasing shareholders' wealth, right? Recall that capital structure refers to the proposition of debt and equity, right? The proposition of debt and equity basically means that the ratio of debt to equity. What we are having, the total value of the firm is more or less like the part of the firm which is being financed by debt and the part which is being financed by equity. It has nothing to do with asset that the firm invests in. What is concerned with which the assets the firm invests in? Changing the leverage of the firm involves increasing or decreasing the amount of debt. So now we are coming back to WACC, weighted average cost of capital, right? Which we calculated as the equity, the proportion of equity times the cost of equity plus the proportion of preference shares. The equity here is the ordinary shares plus the proportion of the preference shares times the cost of preference shares plus the proportion of the debt times the cost of debt. And then we introduce tax to get a tax shield. That's why we are seeing 1 minus t here. We spoke about this in the previous session. I think you can go back to it and enhance your understanding on this. It is an average cost of equity, preferred stock and debt. So use the WACC to discount cash flow of projects with similar risk, firm's current operation. So with the same cash flow, a decrease in WACC will result in an increase in the firm value. Remember, we assume that WACC is more or less like the interest rate. And remember that when interest rate is low, interest rates and the value of a firm are like inversely related. When interest rate is low, firm value increases. And then when interest rate is high, firm value decreases. So that's what we are saying. A decrease in WACC will result in an increase in the value of the firm and the vice versa. So consider capital structure that would minimize weighted average cost of capital and hence maximize the value of the firm. Call it optimal structure, optimal capital structure. So the proposition of debt and capital that will maximize the firm's value is called the optimal capital structure. I think I saw this in one of the objects. Maybe we can see it again. So also recall, for a project that is not of the same risk as the firm, there is the need to determine the appropriate discount rate of that project. Divisions also often require separate discount rate because they have different level of risk. So let's consider these situations, right? We are coming to consider a situation where there is only equity, right? And a situation where there is equity and also there is debt in the composition of a company's capital structure. So current here is saying that the company's asset or the company's capital structure is only containing of equity, 8 million equity, which is here, right? So $8 million dollars of equity. So we will have debt to equity ratio of 0. Remember, debt to equity ratio is debt over equity, right? And debt is 0, equity is 8 million, so we are getting 0. And the share price here is going to be 20, right? So if we want to get the share price, when we divide 8 million by 400,000, we are going to get this share price here. So that's what we are seeing here. And now we are assuming that interest rate is 10%. If in case we are to employ debt, that's why interest rate here is 10%. So proposed here is that half is for debt and then half is for equity, like the composition of the firm's capital structure. So now debt to equity ratio is 1, which is equal to 4 million divided by 4 million. That's why we are getting this one here. Share price is still at the same 20, and now outstanding shares will now be 4 million, which is equity, right, divided by 20, which is the price of the share. That's why we are getting 200,000 here. So interest rate is still the same as 10%. We are moving, and then we are coming to analyze which of this composition is okay. Should we choose full equity, or we should choose an equity, a half equity, and then a half debt, right? So the top here, talking about current situation, is we are having no debt. If you are having no debt and our earnings before tax in normal time is 1 million, then we are paying no interest because we are not taking any debt, right? Our net income will still be what? 1 million, right? Now earnings per share is now going to be 2.5. Earnings per share being 2.5 is going to be the 1 million all over. The number of shares, right? So that is what gave us the 2.5, right? That's what gave us the 2.5 here, right? And then now our return on equity is going to be 100 divided by 1 million divided by the 8 million equity, right? So it's going to be so EPS, and then I don't really need to write. I'm wasting time since I'm explaining it. Okay. So now the return on equity is going to be the income, the net income over the equity being invested. So 1 million divided by 8 million is giving us, so times 100 is giving us 12%, right? 12.5%. That's why you are getting this here. This is in normal time. In good time where we are having good profit like 1.5, we follow the same procedure and we are getting earnings per share of 3.75, and we are getting return on equity of 18.75%. And in bad times when we are having 500,000, we are getting we are getting an earning per share of 1.25, and then we are getting 6.25 of income, right? So in averagely, we are going to get an average of 2.5, which is this plus this 2.5 plus 3.75 plus 1.25 divided by 3, right? We are going to get an average of 2.5 earning per share in normal time, in good time, and in bad time. Like that's the average that we are going to get. So when we check on the return on equity too, we are going to get so averagely we are going to get earnings per share averagely is going to be 2.5 plus 3.75 plus 1.25 divided by 3. Right, this is when no debt. We are going to get 2.5 earning per share. Earning per share, right? And then return on equity. No debt, the same, no debt. Return on equity average is going to be 12.5 plus 18.75 plus 6.25. It's 12.5. Right, this is for when there is no debt, right? So what we are going to do now is we are going to compare these averages to when we bring in debt, right? When we bring in debt. So when we bring in debt, we are seeing that maintaining the same 100 million, 1.8, maintain the same 1 million, 1.5 million, 500 million. So when we maintain the same thing, we are seeing that earning per share in normal times is 3. Earnings per share in good time is 5, and then earning per share 5.5, sorry, and earning per share in bad time is 0.5. So in average we are getting with debt. Three plus 5.5 EPS average plus 0.5 divided by 3, and we are going to get 3. Right, and then ROE average 15% plus 27.5 plus 2.5. So we are going to get 15, right? So if we compare these two averages, we can see here that introducing debt in average will bring an earning per share of 3 as compared to 2.5 when we are not introducing debt, and it will return, we will have a return on equity of 15% when we introduce debt as compared to 12.5, right? Remember, we want to maximize shareholders' worth, so we want to take decisions that will maximize the shareholders which are available worth, right? So between this and this, between introducing debt and not introducing debt, we can see that introducing debt is increasing the shareholders' worth as compared to when we are not introducing debt. So therefore, we conclude that introducing debt in this capital structure is more profitable as compared to not introducing debt. So that is the conclusion for this, right? So let's move. So debt and financial risk. The capital structure decision affects financial risk, and hence the value of the company. The capital structure theory helps us understand the factors most important in the relationship between capital structure and the value of the company. So the capital structure decision, which is developed by Miller and Modigliani, so they spoke about the capital structure being irrelevant, and then this case was rejected and they came in with another one. So benefit of tax deductibility of interest, cost of financial distress, agency cost, and then cost asymmetry. So here they're saying that capital structure is irrelevant is in the sense that they said if you are in a perfect market where there is no tax, where there is no transaction cost, whether you use more of debt or more of equity, still capital structure still remains intact since there is no tax and then there is no transaction cost. But here, for example, benefit from tax deductibility of interest is in the sense that debt does not really attract interest, right? Debt does not really attract tax. So the percentage that is on a debt is more or less like a tax savings, right? So if currently Ghana is charging 35%, let's say 35% corporate tax, right? And you receive a loan which is charging like let's say 15%, right? Automatically you are getting some tax saving because your loan that you'll be using for the business won't really be taxed. So since it won't be taxed, then the difference there is more or less like you are avoiding that tax of that particular list. We'll talk more about this. And then the cost of financial distress is when we bring in more debt, and then agency cost too is when there is there is no good corporate governance, and cost of asymmetric information is more or less like when information is at one-sided, more or less like information is with managers than the shareholders, right, and the like. So let's talk more about it. So we remember that the weighted average cost of capital is the proportion of debt times the tax savings, right, times the cost of debt, plus the proportion of ordinary equity times the cost of equity, plus the proportion of preference shares times the cost of preference shares. We spoke about this in the previous video. So proposition 1 without taxes, which is we are talking about Modigliani and Miller's propositions, right? The first proposition was capital structure is irrelevant. So according to Franco Modigliani and Merton Miller, they develop a theory that helps us understand how taxes and financial distress affect companies' capital structure decision. The assumptions of their model are unrealistic, but they help us work through the effect of capital structure decision. Investors have homogeneous expectation regarding to future cash flows, meaning that they expect the same kind of cash flows. Bonds and stocks trade in perfect markets. This is their assumptions, right? They assume that investors have homogeneous expectation regarding to future cash flow, which is not true. Bonds and stocks trade in perfect markets. Investors can borrow and lend at the same time, and there are no agency costs. Investment and financing decisions are independent of one another. Proposition 1, we are continuing. So they are saying that the market value of a company is not affected by the capital structure. But remember, we just use an example where in good time, in bad time, and introducing debt and not introducing debt, right? We didn't even talk about the tax savings, so we will come and talk about it. So based on the assumption that there are no taxes, cost of financial distress, and or agency cost, so investors would value firms with the same cash flow as the same will value the same cash flow as the same, regardless of how the firm is financed. Reasoning: there is no benefit to borrow at the firm level because there is no interest deductibility. Firms would be indifferent to the source of capital, and investors could use financial leverage if they wish. So now let's talk about it. So they are saying, how come MM1? So consider two firms that generate the same operating income, like what we use. They generate the same operating income. One is levered and one is unlevered. So one is levered meaning that one has debt and one doesn't have debt. That's what we spoke about just previous, that one was chose half debt and so the same thing here. So and its equity is EL. So the firm's value is equal to the firm's value. VL means firm's value is equal to the debt that this is for firm 1. The debt that the firm has acquired plus the equity, right? And then now his equity will be the VL, which is the value of the levered minus the debt, if you want to know the equity that the firm has. So it is more or less like this. So let's say VL is equal to plus EL. So let's say VL is equal to 100. Then it means that debt plus equity should be equal to 100. So if let's say debt is 40, equity is what, 60, right? So if in case we want to find EL where we've been given the same, like just change of subject, right? So if let's say we've been given only right, then EL is equal to 100 minus 40. Right, that's what they were saying, that EL is equal, it will be equal to VL minus DL. That's what we are getting, which will be equal to 60, as you know. That's the basic explanation. So, and then the other is unlevered. The other is unlevered, which means the other is full of equity. Right, so each equity will be EU, and the firm value is equal to VU. So EU is equal to VU. Right, so for this one, for example, for this kind of firm, for example, it doesn't have any debt. So VL is levered. So VU unlevered is equal to EU. This is because he's only using equity. So if, let's say, VU is 100, then EU is what? 100. Right? That's what it means. So now let's consider two investment strategies, A and B, involving the levered and then unlevered firm, which is U is unlevered and L is the levered firm. So strategy 1 is when A1 invests in the unlevered firm. So if A1 buys 1% of the equity of the unlevered firm, the payoff is going to be 1% of the profit, right? Because earning per share is equal to net income over the shares available. So if you're having 1% of shares, then you're going to get 1% of the profit of the unlevered, right? Then strategy 2 is more or less like investing in the levered firm. So if you're investing in the levered firm, then when you buy 1% of equity of the levered and 1% of its debt, because you are going to pay the interest on the debt. So investment is going to be 1%. You are going to get 1% of the debt plus 1% of the equity, right? Your payoff is going to be 1% of the interest paid by the levered plus 1% of its profit, to mean that a cash yield is there. So 1% of profit. Since A and 1 offer same payoff, they must cost the same, else there's arbitrage opportunity. So arbitrage opportunity is more like you can buy something. It's a situation which an investor can buy and sell an asset in different markets simultaneously to take advantage of differing prices from the same asset. So more or less like you buying an asset at lower prices and selling it. So in class, our lecture used an example where, let's say, the cost of yam in Agbogloji is, let's say, 100 cedis, and the cost of Agbogloji is, let's say, 20 cedis, and the cost of yam in East Legon is, let's say, 100 cedis. If you check your transaction cost, right, if you check that transaction from Agbogloji is less than 80 cedis, so let's say if the transaction cost of from Agbogloji to East Legon is, let's say, 50 cedis, then when you buy it at 20 cedis and you come and sell it at 100 cedis, you are making a profit of 20, right? So there's an arbitrage, the same yam but different prices. That's what we term as the arbitrage. So hence 1% of the value of the unlevered is equal to 1% of the value of the levered. So the proposition 2, where we consider WACC. So here we are representing WACC by RA, right? RA. So when you see RA in everything here, it's WACC. WACC is equal to the proposition of debt times the price of debt. We know this already, plus the proposition of equity times the cost of equity, right? So if we want to change subject and make the cost of equity the subject, then we are going to get the weighted the WACC plus, into brackets, WACC minus the cost of debt times the debt to equity ratio, right? So that is it here. So it is more like this. Let me write it here well for you. I don't want to prove anything, just keep this. Once I prove it and it becomes plenty, so you just keep the formula. So KE is equal to RA plus into brackets RA minus RD. Is it RD or KD? Okay, KD. Sorry. Cost of debt all times the debt to equity ratio. Alright, so that's it. So it's more or less like this is the formula. So just keep this. That is, the expected return on equity of a levered firm increases if the proportion of debt to equity. That is, the expected return on equity of a levered firm increases in proportion to the debt to equity ratio. So if debt to equity ratio increases, right, meaning that when we acquire more debt, the expected return on equity will increase, because if you are taking more debt, shareholders will be thinking that very soon maybe the firm will be more of debt, in the sense that they will be afraid of bankruptcy. So they will want to take more return on their listing, so that it can offset something, so that it will still hold them in the business. So, and the rate of increase depends on the WACC minus the cost of debt, as long as debt is risk-free. So this is MM2. Note, if debt to equity ratio is 0, then cost of equity is equal to WACC, right? Remember, if debt to equity here, debt to equity is 0, then our cost debt to equity is 0. Then it means that whatever we will be getting in this bracket will be 0. Then our KU will be equal to the WACC. That's what it means. So MM1 says leverage has no effect on shareholders' wealth, whilst MM2 says expected return on equity increases as firm debt to equity ratio increases. So shareholders demand more when when manager employs more debt. So time cool. Increase in expected return on equity is exactly offset by the increase in the risk. So this leaves value unchanged. I have to run fast. So cost of equity and WACC. Right. So now in this graph, you can see that in this graph, here is the debt to equity ratio, which is the down here, and then here is the cost of a return on equity, which is the same as the cost of equity, right? And then here is the return on debt, which is the same as the cost of debt, right? So cost of debt remain constant throughout. If it is 10%, it is 10% throughout. Weighted average cost of, this is MM1, weighted average cost of capital is also constant throughout. But as we employ more debt, right, the cost of equity increases. The cost of what? Equity increases. This is to offset the tax shield that we think we are getting. Okay, we've not gotten there yet. So when we take more debt, right, shareholders will demand more of this thing. That's what we were saying here. When we take in more debt, shareholders will be demanding more on their this thing that they've invested, right? That's why the return on equity is what? Increasing. So we know return on equity to be this already, times debt to equity ratio, and then WACC is this, to remain constant throughout because there is no tax. So which is Okay, yeah, V is equal to D plus E, which is debt plus equity. V is more or less the value of the firm. It's equal to D plus E, the debt plus the equity. So proposition 2 without taxes, high financial leverage. So MM2, the cost of equity is therefore a linear function of a company's debt to equity ratio. Speaking about this, because creditors have a claim to income and assets that has preference over equity, the cost of debt will be less than the cost of equity, right? So if because when a company is going into bankruptcy, they first pay those they owe first before they will come to the shareholders. That's what we are saying here. As the company use more debt in its capital structure, the cost of equity increases because of the seniority of debt, right? Because debt is more, right? So the weighted average cost of capital is constant because as more of the cheaper source of capital is used, that is debt, the cost of equity increases to offset it. So the cost of debt will increase to offset that thing. So capital, these are three assumptions that we have under them. So we will talk about this very soon. This is MM1, where there is no corporate tax or personal taxes, no bankruptcy cost. And then case 2, MM2, where it is more, we have corporate tax but no personal taxes and no bankruptcy. And case 3 is more or less like static theory, corporate taxes but no personal taxes. We'll talk about this. And there is bankruptcy cost. So corporate borrowing and homemade leverage. So far we have seen that 1, impact of financial leverage is beneficial in good times, right, according to what we saw, and impact is negative in bad times. Financial leverage increases risk, right? So meaning that taking more debt increases risk. Issue is firm value affected by the type of security it issued? When Inglani and Miller said that in the year 1958 book says that in perfect financial market, firm value is not affected by the type of security issued. Yeah. Perfect financial market, individual and corporate bodies can borrow or lend at the same rate, no tax, no transaction cost. We've spoken about this. Then we've spoken about arbitrage profit too. We've spoken about this. We spoke about it, sorry. So this is introducing tax into the MM theory, right? When taxes are introduced, specifically the tax deductibility of interest by the firm, the value of the firm is enhanced by the tax shield provided by the interest deduction. Remember when we were solving the weighted average WACC in the previous session where we introduced tax? You can see that the weighted average was what? Lower as compared to when there was no tax shield. It lowers the cost of debt, lowers the WACC as more debt is issued, increases the value of the firm by the tax. That is the marginal tax rate times the debt. So now this is the value of the firm without taxes and then with tax. So value of the firm for the levered firm is equal to the value of the unlevered firm when we don't have tax. So our work is the same as this. We've solved this already. The proposition of debt times the rate of debt or times the cost of debt plus the proposition of equity times the cost of equity or the rate of equity. And then the cost of equity, which is RE, is equal to RA. Now here they've changed it to R naught, but it's the same as the RA, right? RA, which is the weighted average cost of capital, plus the RO or RA non-bium, which is the WACC now, minus the cost of debt, which is the same as the RD here, all over the debt to equity, all times the debt to equity ratio, right? This is without tax. And with tax, this is the value of the value of FM. The value of the levered is equal to the value of the unlevered plus the tax shield, right? So you can see that with taxes, value of the levered is more than the value of the unlevered, right? Because you are even adding something to the value of the unlevered, sorry. Then our WACC will now be this because we're introducing tax shield. So the tax will affect or reduce the cost of debt. That's why we are adding into the roof. So for this, remember, finance is also step by step. If you miss one part, you will hardly get the next part. So if you are not understanding, kindly watch the previous session where we spoke about WACC with tax, like with introduction of tax, right? Plus, so this is plus the proposition of equity, the same thing. So now our return on equity or cost of equity, sorry, our cost of equity will now be the WACC, which is here was RO, here is RA, but in here, so RO means WACC plus this bracket WACC minus the cost of debt times the tax shield, which is 1 minus the interest rate that we are paying on the loan or debt, all multiplied by the debt to equity ratio. So that's it here. So introducing cost of financial distress. We are coming to talk about financial distress, then later on we will combine everything together. So cost of financial distress are costs associated with a company that is having difficulty in meeting its obligation, right? Cost of financial distress include the following: opportunity cost of not making optimal decisions, inability to negotiate long-term supply contracts, loss of customers, and etc. The expected cost of financial distress increases as the relative use of debt financing increases. This expected cost reduces the value of the firm, which is offsetting in the part the benefit from interest deductibility. The expected cost of distress affects the cost of debt and equity. So it's more or less like distress really affects the cost of debt and equity. We will see this on a graph very soon. Bottom line here is that there is an optimal capital structure at which the value of the firm is maximized and the cost of capital is minimized. So hey, I even forgot to tell you to like and subscribe. So the firm, okay. So this is what we are seeing here: cost of equity and WACC with rate taxes. So here, as in MM1, we spoke about this. When we are bringing in more debt, our cost of equity was also increases. This is because shareholders are afraid of their investment, so we have to induce them with high prices of capital, like high dividends, so that it will reduce their temper in the business, right? So this here is the cost of the unlevered, right? The value of the unlevered remain constant throughout, right? The value of the unlevered remain constant throughout. So that's what we are seeing here. It's constant here. We are talking about MM1. So now, when we are what we are seeing here, RE here becomes the optimum amount of debt we should employ. So above here, maybe we will be facing a higher financial distress. So you can see that RD here is multiplied by the tax shield, right? All right, so let's see. Proposition 1 with taxes implies that a firm's WACC decreases as the firm relies more heavily on debt. So we can see here, right, the WACC is decreasing. The WACC is decreasing, right? And we know how we will solve for work already. So proposition 2 rate taxes implies that the firm's cost of equity rises, right, as the firm relies more heavily on debt financing. So what it means is that as the firm relies more on debt and the WACC is falling, right, we can see that return on equity or cost of equity what keeps on increasing. That's what it is saying here. So case 3, financial distress and bankruptcy. Financial distress, unable to honor financial commitments or honoring them with difficulty. Examples: investors do know that leveraged firms do suffer financial distress and make provisions for this when making decisions. Financial distress is not the same as bankruptcy. Most firms that experience financial distress do not unilaterally file for bankruptcy. Bankruptcy occurs when shareholders walk away from the company and creditors become new owners. Cost of bankruptcy. Cost of going through bankruptcy ultimately cause bondholders to incur additional losses. So disincentive of debt. So bankruptcy cost, direct cost will be administrative, because before you even sign or file for bankruptcy, you have to pay for some fees and the likes. Indirect cost, larger than direct cost but more difficult to measure and estimate. Stockholders wish to avoid a formal bankruptcy filing. Bondholders want to keep existing assets intact so they can at least receive that money. Assets lose value as management spend time worrying about avoiding bankruptcy instead of running. So meaning that instead of they thinking about how to run the business profitably, they are now thinking about how to avoid bankruptcy instead. That's all what it means here. Unwillingness to do business with the firm. Other people will stop because someone is filing for bankruptcy. We won't do business with the firm, right? But if let's say the firm is paying us in cash, they will receive. But if the firm is paying us like buying things on credit, we won't really accept that. So time and effort spent in obtaining bankruptcy, court approval for investment or asset of sale and the likes. So agency costs. Agency costs are the costs associated with the separation of owners and management, right? So more or less like you see, a firm has their shareholders and they employ a manager to run the business, right? So agency cost is more or less like the cost that is associated with separation of the owners from the management. So types of agency cost: monitoring cost, bonding cost, residual loss. The better the corporate governance, the lower the agency cost, and it is true. Agency cost increases the cost of equity and reduces the value of the firm. So financial distress reduces the value of the firm, agency costs, and bankruptcy, right? The higher the use of debt relative to equity, the greater the monitoring of the firm and the lower the cost of equity. So cost of asymmetric information. Asymmetric information we spoke about is when information is one-sided, right? So is the situation in which different parties have different information, right, about almost the same thing. In a corporation, managers will have a better information set than investors, right? Managers are the people running the business, so they know what is at ground, and shareholders are somewhere, so they don't really know what's at ground. And that's why we are saying that managers will have better information set than investors. The degree of asymmetric information varies among companies and industries. The pecking order theory retained earnings, debt, and equity ratio. Taking other theory, it argues that the capital structure decision is affected by management choice of source of capital. That gives higher priority to sources that reveal the least amount of information, right? So that's what it means. So case 3, now we add back bankruptcy cost. As debt to equity ratio increases, the probability of bankruptcy increases, right? Because when you borrow more, there's likely that you are not making enough profit to cover everything. That's why you keep on borrowing. So bankruptcy is likely to happen. At some point, the additional value of interest tax shield will be offset by the expected bankruptcy cost. At this point, the value of the firm will start to decrease and the work will start to increase, right? So when we employ more and more of that, instead of the work increasing throughout, no, it will instead of work decreasing throughout, no, it will decrease, reach a minimum, and then begin to rise. That's what they are saying here. So now we bring the static theory. So static theory and firm value predicts that firm will choose their mix of debt and equity financing to balance the cost and benefit of debt. Right. So meaning that we are not really employing more debt or more equity. We are mixing them in their right proportion, right, to be able to get the maximum profit. So value of the levered and then total debt is here. So according to the static theory, right, the value of the unlevered is constant throughout, right? As we know already, it's constant throughout because the capital structure really doesn't matter. And then the value of the levered will rise, will start rising as we employ more debt, will rise as we employ more debt. It will reach a maximum and then now it will begin to fall, right? So the more and more and more and more the gap between the actual firm value and the value of the levered is what we call the financial distress, meaning that they are really stressed, right? So the difference between the levered and then unlevered is the tax shield, right? Is the tax. Remember, we said that the value of the levered is equal to the value of the unlevered plus the TD. So the difference here is the TD, right? All right. So the difference from the VU to the VL is the TD, but the difference from the actual firm value to the VL is the financial distress. So static theory and cost of capital. So as you are seeing here, so as we made mention earlier that as the firm employs more debt, the work will decrease, will reach a minimum, and then when financial distress sets in, then work will begin to increase. That's what we are seeing here. So return on equity will still, or cost of equity will be increasing as we employ more debt. So our strategy is to find the mix, the optimum mix that will help. So now the optimum mix is when work is at its minimum, right? So according to the static theory, the work falls initially because of the tax advantage of debt. Beyond the point debt to equity, it begins to rise because of financial distress. I was talking about this. Then summary of the case, we are merging the two together. That when the value of the firm is at its maximum, right, then the work is also at its minimum, right? And when the value of the firm begins to fall, right, the work also begins to rise. So that when the work begins to rise, the value of the firm starts falling. So that's when financial distress was sets in. Present value of bankruptcy cost. So it also sets in here. So here we combine also case 1. With no tax or bankruptcy cost, the value of the firm and its weighted average cost of capital are more affected by capital structure. Case 2. With corporate tax and no bankruptcy cost, the value of the firm increases and the weighted average cost of capital decreases as the amount of debt goes up. In case 3, with corporate tax and bankruptcy cost, so now they try, for according to the side, they try to explain everything by the color. So when you see this color in the writing, it is concerning to this. That's what it means. So according to case 3, with corporate tax and bankruptcy cost, the value of the firm VL reaches a maximum at D, the point representing the optimum amount of borrowing. At the same time, the weighted average cost of capital WACC is minimum at D. Let me see if I can edit this. Alright, so I think this is clearer. Okay, so that's what we are seeing. That's what I just read. I think now it's more bigger. You can see it clearly now. So I've explained this already. So the optimal capital structure, does it matter? So that's what they are coming to say. When there is no taxes and there is no cost of financial distress, then capital structure does not matter, because when you take more debt or when you use more equity, there's nothing. So no, it doesn't matter. And here when taxes are in existence, when we have taxes and there's no cost of financial distress, then yes, 99% debt. And when there is tax and there is cost of financial distress, then then capital structure really matters. Benefits of interest deductibility are offset by the expected cost of financial distress. So we cannot determine the optimal capital structure for a given company, but we know that it depends on the following: the business risk of the company, the tax situation of the company, the degree to which the company assets are tangible, the company's corporate governance, then the transparency of the financial information. So we've spoken about this already. The trade-off theory, value of the firm. Firm value can be maximized by determining the optimum mix. I determine the optimal mix of debt and equity, right? So here is market value, here is debt. So here, the value of the unlevered is constant throughout, because since it is only equity, it is constant. The value is constant throughout. But when we introduce debt, right? When we introduce debt, so value of the levered firm without cost of financial distress is this color. So is this. It goes up and up and up and up and up. But in the real world, we have taxes and we have cost of financial distress. So this is the value. That's why it goes up and then it reaches a maximum and then it begins to fall. That's what it means here. So deviating from target, a company's capital structure may be different from its target. It targets capital structure because of the following: market value of outstanding issues change constantly. Market conditions that are favorable to one type of security over another. Market conditions in which it is inadvisable or too expensive to raise capital. Investment banking fees that encourage larger, less frequent security issuance. And then practical issues on capital structure policy. So debt rating is factors to consider, and then leverage in an international settings. Evaluating capital structure policy. Analysts consider a company's capital structure over time, compare with competitors with similar business risk, considering the company's corporate governance, and etc. They also consider the industry in which the company operates, the regulatory environment, the extent to which the company has tangible assets, the degree of information asymmetry, and the need for financial flexibility. Then leverage in international settings. So this is what we are just talking about. So leverage in an international settings. Country-specific factors affect a company's choice of capital structure and the maturity structure within the capital structure. Types of factors to consider in institutional and legal environment, financial market and banking sector, macroeconomic factors. And these are country-specific factors and they are assumed impact. So for this, it's self-explanatory. You can pause the screen and then read it. It's self-explanatory. So when the country-specific factor. So institutional framework, for example, if a country is more efficient, then debt to equity ratio is potentially lower and debt maturity is potentially longer. So if the country has a legal system origin, then country has common law as opposed to civil law, then debt to equity ratio is lower and this one is longer and the like. So that's what it means here. Alright, so this is where we end our slides on this topic. I think I'll record the last one here, and we'll be writing our exam soon, and I wish you guys all the best. I will try and record a session, maybe solving last year and last 2 years past questions, and then I think when we go through that one, I won't be able to solve all though, but I'll be solving parts. Then as we prepare towards the exam. See you. Take care. Please don't forget to like and subscribe to this channel. And then see you. Bye.